Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, investors have been jolted by more capricious policy stances. Wall Street ended last week down sharply as investors reacted negatively to the way the American administration is dealing with its relations with Turkey. The Turkish lira is being pressed lower quicker by a cultural war spat. That is undermining investment in the country, especially by some large European banks, and that in turn is unnerving investors in other systemically important banks. Wall Street was down 0.8%, US bank stocks were down as much as 2.5%. Meanwhile, US inflation rose to 2.9% in the year to July. This is the largest annual increase since September 2008. Even though the US Fed prefers the PCE inflation measure, today's CPI data is sure to be reflected there too, showing US inflation is rising quite quickly now. Even without food and energy, US inflation is up 2.4%. The US Fed will likely raise rates sooner and probably next September. But their inflation is now rising faster than wages, and new real income data shows that take-home pay buys less than it did a year ago. The cost of petrol actually rose an eye-watering 25% in the past year. Fuel oil prices jumped more than a third. These are serious jumps and will now impact how households allocate their spending. And the US federal deficit came in slightly worse than analysts expected. The July deficit was $77 billion, making the full deficit for the year an eye-popping $787 billion. In fiscal 2017, the deficit was $665 billion, so the current year is running 18% worse and will reach 3.9% of GDP. That will make it the highest ever for a non-recession period. In contrast, Canada reported strong employment growth in July and well above analyst forecasts. Their jobless rate dipped as well. Pay rose 3%, a little less than June, but well above their inflation rate of 2.5%. In China, their car market shrank in July, the first drop in 14 months as consumers shifted away from American cars due to the escalating trade spat. And Japan's economy returned to growth in the April-June quarter after having contracted in the first 3 months of the year. The turnaround was due to a rise in household spending and an increase in corporate investment. US Treasury 10-year is weaker and now at 2.87%. That's down 6 basis points from the previous day and pushing their 2-10 curve lower and now under 26 basis points and erasing the steepening of the last month. The Aussie government 10-year is at 2.59%, that's down 4 basis points, and the China government 10-year is at 3.57%, down 1 basis point. The New Zealand government 10-year is at 2.61%, dropping 2 basis points on top of the previous day's 6 basis points, and the day before's 9 basis points. That's a major reset. And gold is down another dollar and now at just $1,211 an ounce in New York. US oil prices are higher, now just over $67.50 a barrel. The Brent benchmark is now just over $72.50 a barrel. The US rig count is sharply higher this week, chasing those higher oil prices. And the Kiwi dollar is starting the week very much weaker at 65.8 US cents after a 5% fall last week. On the cross rates, we're now just under 90 Aussie cents again and 57.6 euro cents. That puts the TWI at 69.8 and a 3-year low. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.